Morning, everyone. Welcome to this morning's edition of the NBC Markets. Morning call. It's Monday. Happy Monday, 27th of July, 2026. I'm Mark Gardner. So stocks finished lower on Friday, but we've seen a bounce this morning on optimism around US and Iran pausing attacks. So a little bit of a tale of, well, what we lost on Friday, we've basically gained back now, and we're showing a touch of optimism to start the week. So fair bit of this will be kind of a little bit of irrelevant. But as you can see on that left-hand side there and in the middle there where AMAT and Lamb Research are next to Caterpillar and below Amazon, and on, they're in the manufacturing, but they're they are chip stocks effectively. And on the left-hand side you've got Intel, Micron, AMD, Broadcom, Nvidia, etc. They were what was sold off essentially, and I think we had the worst week since March for the SOX index. So I don't think that's necessarily going to flow through too much to to the Aussie market. I think we'll just probably have the positivity of the fact that the US stalled attacks or paused attacks on Sunday, I believe, or maybe Saturday night, and then Iran said, well, if you remain paused, we'll remain paused. So but there was still clashes from the Houthis in the Red Sea on Saturday. So look, even someone looking at each other the wrong way at the moment is probably not going to it's not going to end well. So still have to be mindful of it. But look, while the chip stocks and US and Iran are dominating the headlines, there's a bunch of other things happening, obviously, in the background. The 30-year mortgage rates reached an 11-month high as Treasury yields surge. The ECB would be more willing to raise rates into oil-driven inflation than the Fed, and I'll sort of show you why later. Trump's imposed new tariffs on 60 countries, 60 trading partners, which he replaces the expired levy that he put on there that was essentially not legal, and had, where the rule is essentially the executive branch in the US can obviously just sign whatever it wants into law, but that you've got 60 days to get it approved by Congress. Trump's polling at the moment is at its worst level ever. He's squarely being blamed for the Iran war. He's squarely being blamed for the tariff thing. And his popularity is actually below both parties' general popularity. So I'm a little bit surprised he's persisting with all this stuff because I think both parties now are pretty happy to not go with Trump. I think the only leverage he's got really here at the moment is his vindictive nature in terms of pre-selections, but that's kind of for the midterms. That's kind of disappearing now. So look, he may pull back into line, but not normally his MO. So look, oil fell 3% Friday, and then it's up down around about 4 or 5% overall. But Google was down as well. On Thursday with that capex thing. Intel, which was up 10 to 12%, actually gave on Friday. It gave earnings on Thursday after the bell, and then was up 12%, but it has then given back 8% straight away. Made some pretty negative comments around Intel, essentially saying that they're a narrow business. They've got a track record of screwing things up, which they do, and that foundry business and the new photolithography machine that's coming is sort of unproven, and while they've got Elon, so everyone's trying to pick problems with it, which I kind of feel for them because they did report pretty well, and a few of the reasons here, but obviously, as you can see, Nasdaq was down 0.5%, Russell was down 1%. Nasdaq's now recovered. I think futures are up 1.2% this morning. I would expect us to probably head a little bit higher today because we had commodities and things higher. But loads of people, there's a fair bit of talk around, why is Google down? It's a 20 PE, et cetera. But this is one of these things that, they're misquoting. They're leaving an important caveat out with, with a lot of these hyperscalers at the moment is that if you take out the investment gains of their Anthropic and OpenAI, uplifts in terms of, valuations, Google is actually trading pretty expensive at a 42 PE. Median for the last 5 or 6 years, or 7 odd years, this goes back to 2019, is around that 26 mark. And then you've got the free cash flow, obviously, as well, pushing into negative territory. So look, Google will be in negative territory next year, their first, on an annual basis. Amazon does tend to be in negative free cash flow, but look, they're and it's taken a little bit better by the market because I think they're the biggest revenue spinners. Meta will be as well, as will Microsoft. And when we go into negative free cash flow, that's really when investors are starting to question, whether the spend is worth it and what they're going to monetize out of it, etc. Because we, as investors generally are, they're a little bit short-term based. And given these guys are the biggest accumulators of cash piles in history, you start to question, like, how much is too much at some point. So, and then it's been sort of a battle of choosing your, cherry picking your statistic on social media and things over the weekend. Someone compared Google's cash pile to Berkshire Hathaway's, but they're not apples for apples at the end of the day. Berkshire Hathaway's sitting on 360 odd billion or whatever, or nearing 400 billion. Google's about 270. While that's a big cash pile, it's going to be gone. If they're going to spend 200 billion next year on capex, and pretty sure Berkshire Hathaway's not doing that. So, as you got to be a little bit careful and with some of these stats, because there is a camp that is like, going, well, Alphabet's PE is 20, they've got a massive pile of cash like Berkshire Hathaway's. I think it's second only to Berkshire Hathaway. But, that you take out those investment gains on Anthropic and OpenAI and things like that, and their PE is actually a lot higher when you sort of scratch a little bit deeper, and that cash pile is going to disappear pretty quickly. So, make sure you do your own research and make sure you dig in a little bit more. And look, and don't get me wrong, these 4 companies are definitely in the top 10 of things we would be buying if there was a dip. But it's just very important to flag that there's going to be obviously a little bit of negativity around it and a little bit of uncertainty, and you might just get cheaper prices. So you don't have to buy and hold forever. You can be selling here while they're expensive and pick them up 30% lower on a pullback and hold them forever. It's not that's not trading. That's just being smart with your money. When things are expensive, you sell. When things are cheap, you buy. I mean, it's pretty much no matter what anyone says about a million technicals and all the fundamentals in the world. Buy low, sell high is about as simple as it gets. So we do have a fair bit of earnings this week. So in terms of Sydney time, SK Hynix is going to be 10 a.m. Sydney time on Wednesday, or 9 a.m. Seoul time. Results after the close on Wednesday, US time, but 6:30 a.m. obviously Thursday time for Meta and Microsoft. Amazon's going to be after the close Thursday, which will be our Friday morning. And then, Eli Lilly will be next week. And they'll be Wednesday, Wednesday their time, Thursday our time. So, pretty difficult to get calendars that line up. But we've also, on the monetary policy front, we've got the FOMC this week. We have the RBA this week, and we've got that Q2 preliminary GDP in the States as well, core PCE. I believe that's Thursday, and FOMC's Thursday morning. So look, I would say that there's a lot of talk around the fact that massively high 74,000, I think it was, in the unemployment, in the employment number last week, could push the RBA to another hike. That's going to affect the interest rate sectors, obviously. Other central banks as well. We've got Bank of Japan on Thursday, Bank of England on Thursday as well, and I dare say that I think that FOMC meetings will be Thursday morning. So that middle of the week is going to be chock-a-block full of really key, figures and really key earnings numbers from the US. So I would expect the first couple of days of this week going to be pretty quiet, and just be some positioning, because I don't think you want to be taking making any long-term high conviction decisions into what could be one of the more pivotal earnings seasons and pivotal central bank decisions across the globe for the rest of the year, essentially. If the RBA goes, it could be the last one. They might flag that. They may not go. They might think it's transitory. Obviously, we've got a CPI number on Wednesday here. Same with the US. What are they going to? Is oil transitory? We got gasoline at $4 a gallon, which is the psychological level in the peak driving season in the States. There's a lot going on. What this time is probably really useful for is reviewing your portfolios and having a bit of a scan through, particularly into Aussie earnings season, given it has a negative tilt the last year and a bit, whereby anything you think that you're a little bit worried about, it's probably not, the risk reward is not in your favour generally to be taking those through, and we're going to be playing this Aussie earnings season definitely from the react after the number, not trying to predict into the number, because the downside moves are much more severe and horrible than the upside moves. There's certainly ones we'll be watching, but you got to be wary of your risk management, and you got to be wary of what your risk reward is on your investments and your holdings, and what you miss out on the upside does not come close to what you get smashed on the downside in the ASX in these last couple of earnings seasons. So you just got to adjust your strategy leading in. Obviously, gold and silver were a little bit higher on Friday as well. Crude obviously came off, but it's still up, a fair bit for the week. Lithium, uranium were off a little bit, but coal remained a little bit remained fairly well bid. And look, currency's nothing much going on there. I think the Bank of Japan meeting will probably address this current record high recent multi-decade high in dollar yen, and the US might everyone's been expecting the Bank of Japan to intervene, and rates keep going up over there, so it'll be sort of interesting to see what comes out of that as well. You see any of that carry trade come back, and where money gets brought back into the US from the US into Japan, that could be something that potentially triggers it. A long shot, don't get me wrong, but it could be. This is a natural gas price where they're sitting at record highs here at the moment, up 40% in Europe. So that's kind of where they're very much of the opinion that, why they need to obviously hike rates. Very much a stagflationary environment, which is not good for stocks generally. Despite, I think, the German market's towards record highs, but yeah, look, a lot going on. Hyperscalers or hyperspenders was the title of our Bulls versus Bears episode 129 on Friday. You can go to nbcmarkets.com.au/podcasts and click on your favorite platform from there, or you can search for it just search for MPC Markets or Bulls versus Bears, and you can find them on Spotify, YouTube, Apple Podcasts. It is a vodcast, we've introduced Phil DeLockery, a new team member, 30 years experience, or 30 years plus experience in markets and stock trading on the ASX and US and things like and futures and indexes, etc. So we welcomed him to the team, and as just going through how we're looking at things, and how we're generally reacting, and why, a little bit more of an in detail version to what we do here on the morning call overall. Just a reminder, buy the dip index. If you're holding S&P 500 or Nasdaq or whatever indexes, this is definitely worth having a look at. It's available to SOFI, S708, or all retail investors. mpcinvest.co/buy the dip, or you can just go to our homepage, mpcmarkets.com.au. It closes Wednesday. You really do need to get your paperwork in and get your skates on. It's a really good investment. Same underlying, the S&P 500 index, 3 years, but we've put in some great features where you essentially buy the dip for the next 4 months looking forward. So that could improve your entry price. And you're getting, and via some, us packaging up some options, etc., you're getting 5 times to 6 times leverage to the upside and cap downside. So I don't want to explain it too much here. It's worth going and having a look. There's a video explainer on the website. There's also a PDF and a PDS. So get in now, because we probably won't be running this until the end of the year again, I wouldn't imagine. So obviously general advice only, don't know your personal circumstances, etc. But go and have a look today, because it's a great way to get the same exposure, capital efficient, and then smooth out your returns, and use that cash to do something else. Like buy some individual stocks or do some income investments, etc., and make sturdy up your portfolio from a risk standpoint. But thanks for listening this morning, guys. We will speak again tomorrow morning.